What is up, everybody? I am Sean Grapevine, co-branch manager of the Atlanta branch of UMortgage. I am joined here by two men who need no introduction, but we'll get one anyway. We've got the titan of the 10-year, Austin Koenig, and we've got the man who's in secondary markets, but primary in our hearts, Rob Pieklo. Welcome, Rob.
What's going on, guys? I was expecting a longer intro for Austin, at least.
I did one like 2 days ago, and I just I frankly need some new material.
Crack it, Sean. I'll get you some material or something. I don't know.
Thanks.
I don't know how we can provide it, but
during the summit in February, we'll have like some fun inside jokes and talk about some really interesting things, and that'll provide more fodder for my.
Sounds good. Sounds good to me.
Well, welcome everybody. Glad to have you along here, Rob. And just wanted to have a quick review of what's gone on in the market the last couple of days, how the Fed meeting went, what the numbers look like, how the market's feeling, and any actionable items that we can take away from that. Awesome. What do you see?
So, I mean, kind of like we talked about on Monday, 25 bips is what we got in terms of the Fed rate hike. So for those keeping score at home, what the Fed funds rate is really is like 4.75. That's what we're, looking at. And the market is, reacting lifetime to what Jerome Powell's saying. So kind of the schedule here, we had the 2 o'clock release. At 2:30, the press conference starts with, Jerome Powell and his pre-prepared remarks. And then it's a Q&A. You get the people, asking Jerome Powell questions and just, berate him with either criticism or just general remarks, in terms of, well, can you give us more information and exactly how the Fed's looking at this, essentially. So the markets are kind of reacting pretty positively, I would say, to how Jerome Powell is, either saying nothing and it kind of hinting at, there's not going to be too many more hikes, or kind of just not buying what the Fed is selling in some senses too, of, work's not over, all that good stuff. I think the market realistically is looking at probably another hike. And a lot of people think that probably will happen. But the market itself is really just generally pricing only one more 25 bit hike. And nothing crazy is going to happen if we have that. And market is also kind of thinking there's a 50 bit cut by the end of the year. So I think the main things to think about is data is still number one in our hearts in terms of what moves the market, I would say. We've got a jobs report number coming in on Friday, non-farm payrolls, and we have, a lot of additional data that'll come through, as we go along this year about how the economy is faring. So all of this is going to drive what the Fed does. Don't listen to what the Fed says, and really, they don't say everything they actually did say, because we have the minutes that they discussed coming out in about 3 weeks. And I was listening to Jerome Powell's press conference before we hopped on here, just for about 5-10 minutes, and he kind of hinted at, take a look at the minutes about looking at the path forward. Apparently, there was a lot of discussion on that. So I'll kind of leave it at that as my little soliloquy here, but. Rob, I don't know if you want to add anything to what I just said.
Yeah,
Rob, how's this going to affect our lender partners and what do you think? You've been in the secondary market for a long time. What's the net effect to us of all this?
Well, it's the start of what will become a pause. And now you look at it and you see they struck a lot of information out of the minutes here, or out of the statement, and it's definitely, you can see they've changed a lot of verbiage in here and just made it seem somewhat flat, or they call everything just elevated, and we're back to just elevated. They remove some adjectives here as they go through and some explanations. So you see the 10-year reacting. Like right now, if I'm a lending partner and I'm kind of working my rate sheet and say I'm on volatility alert right now. There's a lot of movement right now, and it's getting, I'm seeing it move significantly. Pop back and then significantly move lower again. So you should see some positive moves to rates. But he's like, we're still in the middle of this. So we're going to see how the markets react as this afternoon goes on. But it's a volatile market as usual. We're used to it. And I'm like, while we've been on, I've seen the 10-year in the 350s. I've seen the 10-year in the 330s, and it's sitting around 340 right now. So you're seeing the volatility in something that's supposed to be happily volatile. So, it's volatility alert. I'm pausing if I'm doing rate sheets. I'm making sure that, the company's protected and we're, doing something in terms of rates where we don't pick a side here and we wait for things to kind of fall into line like they will probably over the next few hours. And then I would expect another, pretty hectic day pre-job report tomorrow.
It really has been all over the place, and I think we've seen a lot when we get CPI numbers and when we get Fed decisions, even if they're bullish or dovish or whatever. We see an initial move down, and then we never see successive moves down. Then we see 2 or 3 weeks of just creeping back up bit by bit, back to 350, right? 350, 360. That's where the market's sort of hanging out, and it's like no amount of good news. I mean, not to say that this was particularly good news. It just wasn't bad news. Doesn't seem like any amount of good news is getting us below that 350 mark permanently until Jerome Powell says we're done.
Yeah, in times of volatility, the only true hedge is margin, right? We have to remember that from our lending perspective and our lending partners. Like, you can never get ahead of it when things move this quickly and there's all this volatility. The only thing you can do is kind of add some more margin and hope. And that's what a lot of our lending partners do on high volatility days. So it's never good to like jump in or panic at this very moment in time when you see the rates move like this. You kind of want to give it a pause and see where things are going to fall in line. You do have some room to run with since there's going to be some added margin in a lot of the rate sheets out there.
Interesting. We have a question here, a live question. Guys, keep them coming. It makes me feel so special. Brian Phillips says, what are your thoughts on the amount of BIPs investors already have built into existing pricing and that we may not see 25 BIPs hikes in the near future? So saying, like, I guess it seems like some investors, I'm not sure if they mean like our investors or I guess probably just regular, like on the street investors. What's the effect going to be if, next meeting, Jerome Powell comes out and says, all right, we're done for now.
Oh, well, looks like Rob just got Jerome Powell's cord just yanked for Rob.
I shouldn't have said anything about no. That was lending. That was our lending partners just zapping me because I said there's more margin in the rate sheet. That's what that was. They zapped me right out. But I think he means investors in terms of this looks like a question that would be more about the projected hike. So Austin, go ahead.
Yeah, I think it's a good question, Brian. And honestly, I think when we're talking about just general investors, like what's moving the street, right? I think I kind of what I was saying earlier in terms of like what is priced in and what the market's trying to price in as, Jerome Powell's talking is literally what you're talking about here, which is, do we have another hike on the table? Do we have 2 more hikes on the table? What data do we need to look for? And kind of like, what data is he harping on that is kind of the point of emphasis in terms of their decisions, right? So I think generally the market is priced for 1 more hike. It's trying to figure out how much of more or less of a hike it should price in at. And I think we're, like Sean was saying earlier, we've kind of been floating around this range up and down. It can be volatile, but we're in some sort of like a range that's fairly well defined to, I think, all of us. And at this point, I think that anything that would be beyond 125 bip hike or there's no more hikes after this, that would be something where we'd see a general volatility, either up or down. Another hike would probably go beyond this range that we're floating in right now, and we would be seeing more higher rates on the rate sheet or possibly worse pricing. If we're seeing things that happen with 0 hikes from this point on, I think rates just generally are going to fall. The general consensus here is they're probably not going to pause then hike again. The Fed kind of wants to just stop altogether. I think what is kind of what they're wanting to do. They don't want to kind of play this weird game where they don't know if they're going to hike or not. I think they just need to stop hiking and then just pause for a while. Any deviation from that plan itself will throw the market into some sort of haywire episode. I don't know, Rob, if you have any kind of additional color you want to provide from like the lending rate sheet side of things, but I think like you said earlier, it's very clear. Margin is baked in. That's the only way you can kind of protect yourself. And in this kind of environment where, especially on a day like this, where it's going to be fairly volatile.
Yeah. So if Brian is talking about investors in terms of our lending partners and margin how it's being built, which I don't think he is, but if he is, days like today, the morning, I'm prepping a rate sheet with additional margin in it to protect myself against potential volatility later that I can't get ahead of. That's how I create. So I know it's a high volatile day. And my normal margin structure is 30 basis points. I set up a 45 basis point margin structure for that particular day, especially in products that could be highly volatile. The lower note rates are very volatile. And you kind of see that like MBS are lagging right now, but they're starting to get improvements come. Yep. Looks like 20, 30 basis point of improvement. So you're looking at that. And you just have to prepare for it. And we all know, like we talked about before, there's hedging instruments and all this other stuff you have to do as locks come in, and margins are already pretty slim, wider than they were, 3 months ago, but they're still pretty slim overall. So, just got to protect yourself. You pad your rate sheet a little bit and for this, and then you kind of wait and see. And this afternoon, I'm sure we're going to see a bunch of reprices, probably both better and worse as the market kind of goes up and down.
Well, all right. So if we're going to see reprices for the better, who's going to be our first? Robbie. Who is going to be our first lender, our first investor to send a reprice email? Team. That's. Did you hear that, Rob?
I did. I hear everything. You just can't see me. My camera
right.
just shuts off because of the battery, but then it's turned back on. So
what? All right. So guesses on first lender with a reprice.
I'll take first stab. I'll say it will be. We'll go ahead with a Windsor reprice.
Okay.
I'm gonna go with our friends at UWM. I'm gonna say that they're gonna come in hot with a reprice here shortly. But
I think that's a pretty good guess. I think it's gonna be one of those two. I'll go with Home Point. So just to
there we go. That would be my third guess.
I'll go with Change Wholesale.
They don't change too often. The rates are pretty set. You're starting to see better, some more and more improvement as you're looking at the bonds. I don't know if you see that right now, Austin, but we're starting to see some MBS catch up to the move that the 10 years made.
Now, does this like these little increments of MBS getting more affordable, getting closer to some sort of terminal rate that is like going to be like less volatile, more sustainable for a long period of time? Are we going to see some add-on effect of like, is this going to improve? Last year, all we could talk about was there's no liquidity. Even where rates were, there was no liquidity, so it drove rates up. So as we're kind of coming back down to earth, are we going to get a knock-on effect of like, hey, well, rates came down because rates are down, but we're also seeing more liquidity in the MBS market, or are we still kind of is it still kind of dry?
It's definitely not peak liquidity by any means, but it is coming back, no question about it. I would say there are investors that are in the market. I think there's really kind of a lag, I would say, just generally with the agency MBS in terms of the like banks coming all the way back. I think there is the case for them to continue to have demand there and kind of help the MBS pricing that we see in agency. But when we're looking at even non-agency credit spreads in that market, which we don't need to get into the full technical part of that, but credit spreads have improved, and that's actually good for you'll see for non-QM, even prime jumbo. Credit unions have kind of had to step off the gas. Obviously that can vary locally. Who you're competing against, but prime jumbo, I think some of the reserves are a little tapped out at the credit union level, and this is actually kind of opening the window for a non-agency, so private label securitization stuff that can help with non-owner OC. So think of investment properties with conforming loan limits, second homes, as well as just even prime jumbos getting better rates, from the likes of the UWM or Home Point and stuff like that, where they actually have jumbos that face Wall Street, for example. I think we'll be able to see some better pricing there because anecdotally, it's been a while since I've seen a lot of bonds go to market in the private label securitization space. It was a very quiet Q4. It's definitely, back to a little bit more of a normal production level, but it is still healing by all things considered. Rob, I don't know if you want to touch on that a little bit too.
Yeah, you want rates when it's kind of weird. As rates move down a little bit, you're going to see a little more liquidity and people being more comfortable getting into market or purchasing a bond at a certain level. Maybe premiums go up a little bit. What we care about is what that premium is. Can you embed the LLPAs and other things that are pass through cost into that MBS? And we're starting to get to the point where some of these coupons may actually, with servicing values, may be able to cover that and then some. But we do also have to kind of do the flip side of, remember, like with LLPA changes that are coming into play from Fannie or Freddie, they've also done G fee changes. So things have gotten more expensive for mortgage companies to work with the GSEs as well, to kind of touch on Austin's point, where eventually we'll get to a spot where it makes more sense to go the route and ARB the route of a PLS versus going to Fannie or Freddie for some of those higher LLPA loans plus your G fees. It gets very expensive, and you can almost insure those yourselves and have some backing behind it yourself versus going through a GSE type outlet when this happens. So, we'll see how that goes. The G fee increases that they did kind of quietly, in the middle of the night over the last, few weeks has been, would equate to potentially, 15 to 25 basis points in price that no one's really even, talking about today.
Bummer, Rob. That's a bummer. All right. Well, two action items here for loan officers to actually bring this into their day-to-day life. I've got one here at the end, but I want to lead with one that I don't know the answer to. If I've got a loan right now that I need to submit, do I sandbag and wait half an hour to lock it, or do I go ahead and lock it?
Well, I'm waiting for a reprice. If I haven't gotten one, I'm not looking at my email yet, so I don't know if I've lost or won the bet. But
None yet. I'm so surprised.
So I'm looking at the moves in the MBS, and I'm seeing 30 to 40 basis point change right now. So like you have a little bit of wiggle room. So if I'm locking something, I'm probably waiting to see if I get a reprice for the better. But if that starts to deteriorate, maybe I switch up on that. So I'd be staring at the 10-year, or staring at like MBS Highway or Mortgage News Daily, and just seeing the MBS markets and paying attention to that before doing it. But you have a little bit of room. So things have improved 30, 40 basis points from where they priced and where the active price sheets are. So you have some room to run for a reprice for the better. Yeah.
Do you concur, Austin?
Yeah, I agree with Rob here. That's no question about it. And I would just I'd say this is the one time that's almost like clear as day. Like, it's probably best to be patient here a little bit, especially. I don't think it's going to flip like insanely different direction, like where we're going to have a worsening reprice, within the next 30 minutes, or we're likely to get an end of day reprice from these people, these other lenders, and likely no Armageddon's going to happen tomorrow. But I can always say that and have complete egg on my face. So I would just say let's just be patient for reprice, and we'll see from there.
So LOs, you guys know it. If it goes bad, it was Austin's fault. So we
100%.
We need someone to blame. It's fine.
And don't just sit on it. Don't just sit on it until 6 p.m. and make the lock desk work after hours. Second piece is this: anytime we have any sort of news, right, or any sort of new product. So this goes for UWM's one-time close, and also just for like a thing in the market. I mean, first thing I told my LOs to do is get on their phone, open up the Reach app, which allows you to iMessage, as many people as you want at a time, send a mass text message from your phone number, and just get on there and take the opportunity to be like, hey, real estate agent. I almost died. Hey, real estate agent, the Fed meeting just got done. It looks like rates are going to improve a little bit. They did raise the key interest rate, but it was about as much as the market expected. Market was happy with that, and it looks like rates are going to go down a little bit. Let me know if you want me to go over like how any of this works, or if you're ever curious about this kind of thing. I love nerding out about it, right? Like, invite that in. You can also say, and this is like a kind of a snake move, but it's happened to me. Say, hey, with rates going down later today, let me know if you have any of your clients that you think have too high of an interest rate that they're locked in at. I could take a look at their LE and let them know whether it's a good deal or whether we can beat it. And see if you can't, weasel one out every once in a while. That's a strong grapevine method, and it works. I mean, I've had it happen to me, so I don't mind doing it to others, and I don't mind providing a better deal and better service to my agents' clients. So 2 opportunities there. The one-time close thing, definitely be like, hey, this just came out. I'm getting more information about it. Let me know if you want to hop on a call next Tuesday, or we could like hop on a Zoom, or meet up for coffee, and I can go over the one-time close, see how that can benefit us, how that can make us more money in the coming year. So lots of opportunities. Every time there's a piece of news, text everybody about it, and just kind of like kind of sneak into trying to have some sort of dialogue about it. And it makes you look like an expert, makes you look friendly, makes you look knowledgeable, all those things.
In a positive way, right, Sean? Like it's very easy to look at every single incredibly wrong post that our referral partners and even loan officers in the industry post on days like today. You don't have to be the know-it-all about the market. You simply just want to educate and be like, hey, by the way, short-term rates went up, but long-term went down. That means mortgage rates are getting better. So it's about how you do it, because there's a lot of false information out there, and people that have been in this industry for a long time still equate Fed moves to a mortgage rate move. So
sure, yeah, I would even keep it off social media. Just use it as a conversation starter to one-on-one. There, like, you just get a bunch of just people jumping in your comments saying, "Oh, he shouldn't have done it. He should have done it. They should have done this. No, what's actually going to happen is this." Like, I wouldn't invite the public into this. You're an expert. You're getting inside information to your real estate agents as it happens, or whoever your referral partners are. That is key to their business and sets you apart as an expert and as a value add to their business. Yeah, guys. Well, all right. It's better than I feared it would be, and less of a move than I feared it would be as well. And it looks like it's going in our favor. We've got an outstanding bet here for bragging rights about which lender is going to reprice first. Rob says Windsor. No,
I want Windsor.
Rob says Windsor. Austin says UWM. I say Home Point. And let us know if you have any questions. Feel free to drop a comment on this video. We will definitely see you all next week for the Monday market update. Austin, when's the CPI data come out?
Oh, you're gonna put me on the spot like that? I think it would have to be at least sometime, not until next week, obviously. So we'll talk about that when we meet on Monday. But I think it's got to be coming probably sometime in the second week, at least of February, if not the third week, right? So
my favorite day of the month.
It'll be sometime soon.
Favorite day of the month. Well, thank you all, fellas, for joining us. That was fantastic. We should do this every Fed meeting. And like I said, everybody let us know if you have any questions, and go lock some loans, or wait for a second, let the reprice happen, then go lock some loans.
That's better.
There we go.
Thanks, Sean.
Cheers.
Thanks, guys.
Thanks, guys. Have a great day.
Thank you.